44.50 is what your view on TCS is. But I remember HDFC Bank down 8% in this month itself was your call. You got that spot on. Thank you, Manish, for joining in and giving us your calls. But, you know, moving away from the equity market, and perhaps one of the bigger reasons for the decline in the equity market today could also be on what's taking place in the currency market, the rupee market. There is a fair amount of drama that is taking place right now. 86.4650, closing in on 86.5 out here. Bond yields have spiked as well following a rise in US yields. Who else do we go to for all things macro? Latha has joined us in the studio. Latha, rupee's only falling more.
Well, if the rupee buys less, obviously everything falls, and that's what we are witnessing at this point in time, a fall to 86.46. And that means a 0.5% fall. This is the sharpest, record keepers tell us, since February of 2023. But who knows, that record could be taken. Many Asian currencies, baht, Filipino peso, ringgit also falling, but yuan, onshore and offshore, haven't fallen. Clearly, if everything is falling, it's because the dollar has risen. The dollar index is up by almost 0.5%, 0.43. So this is an arithmetic fall that you're seeing in all the currencies. The key reason, of course, is that the US jobs data has come in very strong, much stronger, 256,000 compared to the expectation that only 155,000 jobs will be created in December. And that means if the economy is strong, there is no need for a rate cut. And also, if wages are higher, the inflation numbers may also be higher than expected. Again, no reason for a rate cut. And that's the reason why yields have also spiked. Now, just finishing the rupee argument, the dealers say largely the buying of dollars is by equity guys, FPIs. And usually there is a sale by RBI. Today, people have not reported too much of RBI supply of dollars. Usually, RBI doesn't stand in the way when it's a global trend. The yield market, as I told you, the US yields have risen, and that is getting reflected in India. The bond yields, 10-year bond yields are up by about 3 basis points to 6.83 from 6.8. But that's not the story. The story is the one-day money. Call rate has jumped to 7%. Now, the call rate should be what the repo rate is. Why does the MPC declare a repo rate? It tells the RBI you have to keep one-day money at 6.5%. That is at 7. Why would it be, you know, people, it's quite possible that there is an argument that the Reserve Bank is keeping the liquidity tight so that people will stay in rupees. It gives you a higher yield for one day, 7%, rather than jump to the dollar. There is that theory doing the rounds, but the Reserve Bank has announced a variable rate repo to give 50,000 crores to the market. But the deficit in the market is almost 2 lakh crores. So this is not going to suffice. And we are going to see yields very high. US 10-year yields have jumped to 4.76, about 7 basis point jump on Friday itself. And therefore, you will see commensurate moves in the Indian market. The important point is now the rate cut that was expected in the February policy, you know, what with the new governor and all those hopes, that is completely wiped clean. Now, the expectation, which is why the yields are jumping, the expectation now is that probably a CRR cut is needed, another 50 basis. No one's talking of a rate cut at this point in time. That's the new reality that the bond market's faced with.
Both in India and in the US as well, right? Latha, thanks a lot for that explainer on the rupee nearing towards 86.50 now.